regards to the retirement of a partner, today we're discussing about the retiring partner's interest. So what exactly is the mode for payment in case of the interest with regards to a retiring partner? So we've seen few questions wherein we saw there's a loan account, right, that they are going to pay a partner in cash, or they can transfer the amount due to the partner to his loan account. And sometimes you see that on the loan account there is an amount of interest. Okay, so what are the different modes of payments? First, to the retiring partner. Now, the provision of the partnership deed is to be taken into consideration when deciding the mode of payment for the retiring partner, whether the partner will be paid in cash, whether the partner will be paid later, the loan account will be created. Okay, now if there is no partnership deed, then the partners should decide it mutually, and the amount payable to the retiring partner can be paid off either in one lump sum or it can be paid off in installments. Now, if it's paid off in one lump sum, that is, if all the amount is paid together at one shot, then this is usually in case of a small amount. Okay, when the amount payable to the partner is small and there is enough cash in hand, enough cash with the organization, with the firm, then the entire amount can just be paid in full after retirement. So in that situation, you have the journal entry, retiring partner's capital account, debited to cash or bank account, the full amount that you're paying to your retiring partner. Now, there is another way in which we can pay the retiring partner, that will be in installments. So this is usually in case there is not enough money. Okay, when the amount payable to retiring partner is substantial, quite a huge amount, and there is not enough cash or bank balance, so the amount can be paid in installments. So the number of installments, then the rate of interest on those installment amount, the time, and the amount for each installment can be divided by the partners mutually, provided there is no provision mentioned already in the partnership deed with regards to this particular payment. Now, generally, the amount payable to the retiring partner will be transferred to his loan account, as we've already seen, and the loan account will be credited with periodic interest and will be debited with installment paid. So you can have the journal entries with regards to this. Firstly, when the amount due to the retiring partner is transferred to his loan account. Okay, so when the amount due to retiring partner is transferred to his loan account, then your journal entry is retiring partner's capital account debited to retiring partner's loan account. As you've seen in the questions, we've done the partner's accounts, we've created loan account, wherein the amount balance of your retiring partner is transferred to his loan account. Okay. Now, if there's any interest due, it should be added to retiring partner's loan account. So it will be the journal entry, interest account debited to retiring partner's loan account. And when they're paying the installment, then the retiring partner's loan account will reduce, right? And how is it going to be reducing? Through payments of cash. So payment of installment will be retiring partner's loan account debited to cash or bank account. Now, there is another way in which we can pay the partner. This is by way of annuity. Now, when we're paying by way of annuity, the remaining partners may agree to settle the claim of the retiring partner by paying him a fixed annual amount called as annuity. Either they can pay it for a certain number of years or for the whole life of the retiring partner. Now, in this situation, in this case, the total amount payable to the retiring partner will be transferred to an account known as an annuity suspense account. Remember, this is also a suspense account. Now, this amount will be credited with interest at a fixed rate per annum on the diminishing balance method, and will be debited with the amount of annuity paid. Now, in the event of death of the retiring partner before the amount is exhausted, then the balance of the annuity suspense account will be transferred to the remaining partner's capital account in their profit sharing ratio. Okay, in the event of death of the retiring partner, then the continuing partners will get the benefit of the annuity suspense account. Now, if there is a credit balance of the annuity suspense account, if it's exhausted before the death of the retiring partner, then subsequent installment of annuity will be charged to profit and loss appropriation account of the continuing partners. Okay, so if the annuity suspense account is exhausted, if there's no more money left in that account before the death of the retiring partner, then the continuing partners will have to pay by way of annuity. Okay, so look at a question. On the 31st of December 2012, P retired from active partnership and his share of the following was ascertained on the date of retirement. You have goodwill, rupees 20,000, interest on capital, rupees 500, salary, rupees 1,500, drawings, rupees 20,000, interest on drawings, rupees 2,000, shares of profit, rupees 25,000, capital, rupees 75,000. Now, the amount due to P was to be kept with the firm as a loan bearing interest at the rate of 10% per annum, which was to be paid to P by annual instances of rupees 50,000 each, interest being calculated at 10% per annum on the unpaid balances. And the first installment was paid on 31st of December 2013. You are going to be required to prepare P's capital account and also P's loan account until the payment of the whole amount due to him. So open P's capital account as well as P's loan account. So we have opened your partner's capital account. Now in case of P's capital account, they've already given to you here in the first line, P retired from active partnership and his share of the following was ascertained on the date of the retirement. That means whatever amount has been given there is already been calculated as P's share. Okay, so we have to record P's share in P's capital, and after that whatever amount is due to him, we'll transfer it to his loan account. Okay, so firstly, look if there's find out if there is a balance of your partner. So you have capital given there in the question, capital of 75,000, that is the opening balance. So write it down by balance brought down. So balance brought down is rupees 75,000. And next, after that, you can write the remaining. Goodwill is also there. So by goodwill account, the amount is rupees 20,000. Remember, these are already divided for your partners. So this amount is for partner P. And then by interest on capital. Interest on capital also has already been calculated, is rupees 500. And then salary also is there. Then by partners salary, account. Salary account is given rupees 1,500. And drawings have also been given there. So to drawings account, drawings is rupees 20,000. So record that amount, rupees 20,000. And then you also have an interest on drawings. So record that. To interest on drawings. To interest on drawings account. Amount has been mentioned as rupees 2,000. And next, share of profit. So by profit and loss account. By profit and loss account, this is profit. Share of profit of your partner P is rupees 25,000. Okay, so after this, there are no other things that are mentioned here. So let's close this account first. Close your partner's capital account. See the total. Total is coming to rupees 1,22,000. And balancing figure is rupees 1 lakh. And we know that in case of a retiring partner, we always transfer it to his loan account. There's no closing balance. It'll be either paid in cash or it'll be transferred to the loan account. Okay, so this is our balancing figure which we have transferred to the loan account. So next, open your loan account for the partner. Open P's loan account. Okay, so in case of P's loan account, you will also have to write the dates for this because the dates have been given in the question. Okay, even in case of capital account also, write down the date as 31st of December 2012. The date has been given. Okay, now the reason why we're writing down the date is because there's this line here. The first installment was paid on 31st of December 2013 because we're paying the installments on P's loan. We're paying interest on the loan, so we have to write the dates down also to ensure we are recording it properly. Okay, so firstly, in case of your account, so you've prepared your loan account, date particulars rupees, date particulars rupees. Firstly, we'll record the opening for your loan account, which is from the P's capital account. So the date for this is 31st of December 2012. Okay, make sure you're writing the date 31st of December 2012 by P's capital account. You opened it with the amount of rupees 1 lakh. Now the accounting period they haven't mentioned, so the accounting period is December itself, okay, January to December. And the question was given, the amount due to P was kept with the firm as a loan bearing interest at the rate of 10%. So just as a reminder to myself, I will write it here at the rate of 10% interest. And to be paid by annual installments of rupees 50,000 each, interest being calculated at the rate of 10% per annum, and the first installment was paid on 31st of December 2013. So as on 31st of December 2012, there is nothing that is going to affect the loan account. You need 1 year to get the interest also, right? So to balance, carry it down, we have to close down this account first and give it as balance closing down. Okay, so this is for the year 2012. And next, let's move to the year 2013 with the opening balance 1st of January 2013 by opening balance by balance brought down rupees 1 lakh once again. All right, and then on the 31st of December 2013, they've already mentioned the first installment was paid, and installment is rupees, annual installment 50,000. So it'll be paid through a bank. So to bank account, we are going to be paying rupees 50,000. Now there's also interest at the rate of 10%. So 10% of 1 lakh. Okay, 10% of 1 lakh is the interest rate, and interest is rupees 10,000. This is your actual amount of installment, and this amount is your interest rate. Okay, so there we are adding these two together here, and total payment to be made is rupees 60,000. So now you have a balance to balance closing down rupees 50,000. And on this end also, because we're paying interest by interest account rupees 10,000, that is the amount of interest it'll be on 31st of December 2013. Okay, so total is rupees 1 lakh 10,000. Both sides it is rupees 1 lakh 10,000. And next, again, let's open the balance 1st of January 2014 by balance brought down. You only have balance of rupees 50,000 now, and you have an interest due by interest account, interest due as on 31st of December 14. Interest due is rupees 5,000 now, because 50,000 is the balance, 10% is the interest rate, so it is rupees 5,000. Okay, because it is based upon the amount of interest. The interest is based upon the amount of loan that is due to your partner. Okay, so it's only, as it's been given in the question, interest being calculated at the rate of 10% on the unpaid balances. So unpaid amount is 50,000. Interest will be at the rate of 10%. 50,000 into 10% is rupees 5,000. So now let us pay on 31st of December 2014 to bank account. So we're going to be paying the annual installment of 50,000. Plus we're also paying the interest at the rate of 10%, which is rupees 5,000. Then we're getting rupees 55,000. And when you close this account, you're getting debit side and credit side, both rupees 5,000, 55,000, and there is no further balance to be transferred in your loan account. So this is how you're paying loan account for your partner, in addition with the interest on the loan amount. Okay, so this is loan account. Now let's look at another question, a very similar question. Question 14, the balance sheet of M, N, and O, who are sharing profits and losses in the ratio of 1/2, 1/3, and 1/6 respectively, was as follows on 30th of June 2012. So you have the balance sheet there, liabilities and assets. On the liability side, you have bills payable 6,000, sundry creditors 12,900, capital for M 40,000, for N 25,000, for O 20,000, and you have profit and loss account rupees 4,500. Then you have cash in hand rupees 150, cash at bank rupees 25,500, bills receivable 5,400, book debts 17,800, stock 22,300, furniture rupees 3,500, plant and machinery 9,750, and you also have building worth rupees 24,000. Now M has retired from the business on 1st of July 2012, and the assets were revalued as under. So you have stock rupees 20,000, furniture rupees 3,000, plant and machinery rupees 9,000, building rupees 20,000, and rupees 850 is to be provided for doubtful debts. Now the goodwill of the firm is agreed to be valued at rupees 6,000. M is to be paid rupees 11,050 in cash on retirement, and balance will be paid in 3 equal yearly installments with interest at the rate of 5% per annum. Prepare the revaluation account, M's capital account, and M's loan account till it is finally closed. Okay, so this is just like the previous question. However, here you have 3 partners and you also have an additional account, which is your revaluation account. Okay, so start first by opening the revaluation. So I've prepared my revaluation account. Now the different assets that are affected are stock rupees 20,000 now. Earlier stock was 22,300. Now it has reduced to 20,000. So to stock account amount of rupees 2,300, and we also have furniture, which is now valued at 3,000. Earlier it was 3,500. Again, to furniture account amount of rupees 500. Next asset is plant and machinery, is now 9,000. Earlier it was 9,750. So plant and machinery also. Plant and machinery account rupees 750. And then you have buildings rupees 20,000. Earlier buildings were 24,000. So buildings also. To buildings account, difference of rupees 4,000 will be recorded, and rupees 850 are to be provided for doubtful debts, and your book debts has increased by provision. So to provision for doubtful debts, to provision for your doubtful debts, it is rupees 850. Provision for my doubtful debts rupees 850. So clearly there is no other amount, so this is a loss and will be transferred to your partner's capital account. So by partner's capital accounts, capital account of your partners, you have partners M, N and O. So they are sharing in the ratio of 1/2, 1/3, 1/6, or the ratio of 3:2:1, and the amount is rupees 8,400 divided in their ratio. Will be getting for partner M rupees 4,200. Amount for partner N is rupees 2,800, and for partner O is rupees 1,400. All right, so this is our revaluation account. Next, let us prepare, they've told us to prepare revaluation, M's capital and M's loan account. So next, prepare your M's capital account. So for preparation of a capital account, firstly, opening balance. Opening balance is given in the balance sheet. For M, rupees 40,000. So let's record that by balance brought down in case of M, rupees 40,000. And in case of revaluation, also let's record that amount to revaluation account. For M, it was rupees 4,200. Okay, now let's check what else is there. So we have already recorded your various assets. Additionally, it is given the goodwill of the firm is agreed to be valued at 6,000. 6,000, which means that M and an O together have earned a goodwill of rupees 6,000, but we're only preparing M's capital account, so we only need goodwill for partner M. So by goodwill account, if it's only for partner M, rupees 6,000, and share of partner M in the firm is 1/2. So half of 6,000 is rupees 3,000. And then it's also been given here that M is to be paid cash on retirement, cash of rupees 11,050. So write that down. To cash account, amount of rupees 11,050. Okay, the amount to be paid. Now go through the question and see if there is anything else that you might have missed. Okay, so all the adjustments we have recorded, stock and all the assets change in value. We've also recorded goodwill. We've also recorded the payment in cash. Now let's come to the balance sheet and check the balance sheet once again. Check for any undistributed profits or undistributed reserves. So on the liability side, we have profit and loss account of rupees 4,500. Right, the profit and loss account is an amount which is earned by all three partners. We have to divide it and distribute it to our three partners, keeping in mind especially for partner M. So by profit and loss account, amount is rupees 4,500 distributed to your partner in the share of 1/2. So half of 4,500 will come to rupees 2,250. So cross check once again. There are no other things in your liabilities, nothing in your asset side also. So with this, we can close our partner's capital account, M's capital account, and the total comes to rupees 45,250. Okay, total for the partner comes to rupees 45,250, and the balance is transferred to loan account. So to M's loan account, amount is rupees 30,000. Right? So we have calculated the loan account amount also. So now let us move to the preparation of our loan account. So in case of loan account, they have given you the dates in the question. M retires from the business on 1st of July 2012, and the balance sheet is prepared on 30th of June. So your time period, your accounting year is 1st of July till 30th of June. Okay, so let's start on the prepare also a date column additionally. So make sure you're preparing a date column, date particulars rupees, date particulars rupees. So firstly, the amount that is to be transferred to your loan account from your capital account. So on the 1st of 2012, we have the balance by M's capital account. The amount is rupees 30,000. All right. So in the question, it is given M is to be paid 11,050 in cash in retirement and balance in 3 equal yearly installments with interest at the rate of 5% per annum. So how much is the interest? How much is the annual installment? You are paying 30,000, right, in the loan amount. So divided by equal installments. So per year you'll be paying 10. Okay, because equal installments, right? So 30,000, if we are going to pay it equally in subsequent years, we'll be paying 10,000 per year. That is how we're dividing it. And interest also will be paid on the amounts at the rate of 5% per year per annum. So this is how much capital. And then next, you'll be paying interest on 30th of June 2013 by interest account. Now interest at the rate of 5%, it comes to rupees 1,500. 5% on 30,000. So let us pay these amounts now. 30th of June 2013 to cash account or to bank account, whichever you're writing, to cash account. Amount is the installment 10,000 plus our interest 1,500. Total payments are 11,500, right? So now you have a balance brought down, balance of rupees 20,000. Okay, so get the total also close the account also. Of course, the balance should be calculated after you've gotten the total, but since we already know it's going to be paid in equal monthly installments, it's quite easy to calculate the balance without even closing the account. Anyway, moving on, next opening balance on 1st of July 2013 will be by balance brought down for your partner. Balance brought down is rupees 20,000, and as on 30th of June 2014, we have an interest by interest account. Interest is 5% of 20,000. 5% of 20,000 comes to rupees 1,000. All right, now let's pay this amount off as on 30th of June 2014 to cash account. We're paying the installment, equal installment, rupees 10,000 plus the interest of rupees 1,000 comes to rupees 11,000. So close this account, 21,000, and get the balance also. So on the same date, to closing balance, we have gotten the total 21,000 minus 11,000. Total is rupees 10,000, which is also the last installment to be paid. Okay, as per we have the calculations that we have made. And next, as on 1st of July 2014, your opening balance by balance brought down, the amount is finally rupees 10,000 now. And also, how much is the amount of interest as on 30th of June 2015 by interest account. Interest is at the rate of 5%. So 5% on 10,000 gives us rupees 500 interest. Interest is always on your diminishing figure. And now, as on 30th of June 2015, let us pay the amount to cash account. We are paying the amount monthly, the yearly installment plus the amount of interest, 10,500 in total. Let me close this account now. So I've closed this account and my debit side and my credit side are equal. Therefore, it shows that we have paid all the the yearly installments, and we've also made the interest payments due to M on his retirement. Okay, so this is how we can pay the interest due on the loan. So you can try again all of those other loan accounts that you see. You can try other sums also with regards to these calculations.